The wait is over. Banks and credit unions have officially started using the new FICO 10 and FICO 10T scoring models.
Joanne Gaskin is a vice president at FICO. She says 40 million Americans are likely to see their FICO scores drop by 20 points or more.
The biggest change is the change in treatment for personal loans.
Borrowers will see their credit score decline if they're in the lower FICO score range, pretty much 580 and below. Now, here's a new hack to use. Get your notepads out because in this video, I'm going over how the FICO 10 and FICO 10T scoring models is either going to help you or hurt you. The hundreds that are members of NAFQ. NAFQ stands for the National Association of Federally Insured Credit Unions, and they're the ones who actually introduced this scoring model to all of their credit unions. Now, many of the credit unions that are members of NAFQ plan on using this scoring model in 2024. Now let's go into why is all of this even important. Chapter 1. What is FICO 10 and 10T model? FICO score 10. Many things have stayed similar to make it easy for lenders to transition from old models. This means the scoring model uses the same reason codes and consistent scoring ranges from previous models. FICO score 10 does not use trended data like the past models to give lenders the flexibility of using the model they prefer to use. FICO score 10T. Now, the T stands for trended data. The FICO score 10T, on the other hand, uses trended data, also known as time series data. Trended data will give lenders a historical view of a person's credit history from the previous 24 months. This is the first time that FICO will use trended data in their scoring model. Previous models only gave lenders a small window into a person's credit history, but trended data allows lenders to see behaviors and patterns used on a longer snapshot of a user's credit history. For example, lenders can see if you tend to run up high balances on your credit card during the month, even if you've never made late payments. Trended data. The use of trended data is the main source of the other major changes. Since lenders can take a historical look into a borrower's behavior, they can make more informed decisions. In this interview with NPR, the president of scores with FICO, Joanne Gaskin, talked about this in more detail. Let's take a listen.
The biggest change is the change in treatment for personal loans. Mostly those who will see a score decline are already in the relatively lower FICO score ranges, so like 580 and below.
Personal loans. Using personal loans can drop your score if FICO determines you're irresponsibly using it. In the old model, your score may have gone up if you paid off a large sum of debt with the personal loan. The new model will look at your behavior over a longer period of time to see if you've continued to keep your balances low or if you've increased your revolving debt after paying off the loan. For borrowers who do the latter, they can see a potential drop in their credit score. High balances and revolving debt. A high balance and revolving debt will more severely impact the credit scores with this model compared to previous ones, since FICO score 10T can track your debt over time. Both high balances and revolving debt impact your credit utilization. Late payments. Late payments, also referred to as delinquency, will also more severely impact a person's credit score. Chapter 2. How could the changes affect you and your score? Borrowers will see their credit score improve if they've currently had a good credit score, but will see a decline if they're in the lower FICO score range, pretty much 580 and below. About 110 million consumers will see a change of less than 20 points to their score under the new score model, and roughly 80 million consumers will see a change in score of 20 points or more in either direction, upward or downward. Chapter 3. What should you do if you think your score will be negatively affected? Pretty much, guys, you just want to follow the basics. Pay down any high balances, start and maintain an emergency fund, which is not necessarily credit cards. It's going to be raw cash in a savings account. And then number 3, avoid building high balances after paying off debt with a personal loan. Now, here's a new hack to use. You can actually pay the balances more frequently in the same month to keep them low. Trended data can work against you if your balance is consistently high throughout the entire month. You can make smaller payments within the same month more frequently and decrease your spending to keep the utilization low. That's what the new model is going to be looking for. Chapter 4. When will more banks and credit unions start using the scoring model? Honestly, it's hard to say, and that's mainly because credit unions and banks, it's not mandatory for them to use a particular scoring model. At the end of the day, they can pretty much use whatever they like. But keep in mind, they're more than likely going to use whatever model that everyone is saying is more profitable, going to bring them more business, but overall, what's going to keep the clients happy. Now, YouTube says since you've watched this video, you're more than likely going to like this next one. Let's see if they're right. I'll see you there.